Broadcasting from beautiful, tropical Vero Beach, Florida, it's Money Nation with Ed Gardner. Now here is your host of Money Nation, Ed Gardner.
Good morning. Today we have Dave Iben from Kopernik Global Investors. He's both the founder and the chief investment officer and the lead portfolio manager for Kopernik. Dave grew up in California. He then earned his bachelor's degree from the University of California, Davis, and then he went on to get his MBA at USC. He began his career with the Farmers Group, where over 14 years he worked his way up from an analyst trader to the director of research and the lead portfolio manager, managing $16 billion. And prior to Kopernik, Dave managed $2.7 billion global value portfolio at Vinnick Asset Management. And then he founded Kopernik Global Investors. Dave, thank you very much for being with us today.
Well, thanks for having me. Pleasure to be here.
Dave, does the Kopernik's view and your view on the mining stocks versus the physical stocks? We're going to be talking about gold and silver and metals today. What's your opinion on those?
Kopernik, we are fundamental value-based investors. Everything's bottom up. So our view is we like things that are undervalued in the marketplace. If you take commodities in general right now, not counting the last few months, have been underperforming for a lot of years. So we look at them and say, well, what does it cost to build mines as fast as you're depleting existing mines? And whether it's copper or gas or silver or gold, we're finding the price needs to be a lot higher than it is right now, or we're eventually going to run out of supply. So we are pretty big fans of those commodities and a few others. So we like those. But to your point, if we can buy gold that's worth probably north of 2,000 and we can buy it for 1,700, we're happy to do that. But by buying it on Wall Street or Bay Street, we think we're buying it at half price. So we're big fans of buying gold stocks. So we like gold stocks even better.
What about the miners versus the physical companies?
The physical companies, same thing there. I think we just view the physical holdings as something everybody should have some investment in. The miners, we actually view them as physically holding it also, but they're physically holding it underground. The bad news is it's difficult to mine it, but the good news is we are buying it, as I say, at half price, adjusted for those prices of bringing it up. So we like the miners quite a bit.
So you'd advise for both. What do you think the price of gold and silver are going to go to, both short term and long term, Dave?
Short term, we have no opinion. We've been doing this a lot of years, and the short term, the market's going to do what they want. Ben Graham's thing, in the short term, it's a voting machine. But to your point, in the long run, it's a weighing machine. Things must get to their fundamental price. So most commodities, like I say, get to that price where it incentivizes people to build on mine supply. We think for gold, that's north of $2,000. For silver, it's probably closer to $50. So that's one way of looking at it, and that works for all commodities. But gold and somewhat silver too have a long history of being monetary assets. And so another way to look at that is, the dollar was once a claim on gold, and since 71 it has not been. However, if you look at the dollar as money and you look at gold as money and you look at the ratio between the two of them, the supply back in 1980, there were about $400 in supply for every ounce of gold the U.S. had. The ounces of gold have stayed the same as far as we know with the U.S. The quantity of gold is now well up into the thousands, so tens of thousands. And so a case can be made that gold is worth 2,000 something on an incentive price and 15,000 plus as a form of money if and when people lose confidence in the in the price. Now, us as bottom-up investors, we look at it under various scenarios. So we only want to buy things where if we're wrong and the price of gold stays where it is, we still make money. And most of the gold companies we have still make money at 1,700, or still are worth this price at 1,700. At 2,000 plus, they're worth a lot. And if and when people start to view gold as a monetary substance, the optionality is really tremendous on gold stocks from here.
Your $6 billion you guys manage through your various funds out there. What else besides gold and silver are in these funds?
Yeah, we are a global manager. So we go all types of stocks, all sectors, all countries, all market caps. So most people like us would own basically no gold, but we have a lot of the portfolio in other countries and emerging markets, good quality companies like trading companies in Japan or utilities in Brazil or Russia, the phone companies in Korea. They're very cheap and cash flow generative. But then a lot of what we own are what we consider latent value assets that are volatile over time, but are trading way below that incentive price. So gold we've talked about, we have roughly 25% of our portfolio in gold and silver, which is the most we ever go, which changed over the last year and a half as we've gone from fairly low exposure to energy to quite a bit of energy. We like oil okay at these prices. Natural gas we view as fundamentally well undervalued and underappreciated. And then we have significant holdings in uranium. Uranium is a substance that is fairly cheap, fairly clean, CO2, non-greenhouse gas emitters. So nuclear power is not going away. Where the supply of uranium is insufficient. The price has fallen from $137 a pound 15 years ago to bouncing around $30 now. We think that price needs to at least double, possibly triple to bring on the mine supply that's going to be necessary. So we're very constructive on uranium.
Very interesting, very interesting. How does your approach differ from other investors, most other investing companies?
Yeah, everybody, including us, likes cash flow. But for things that aren't cash flowing now, a lot of people underappreciate those things. We do the analogy of an office building. It's not worthless when it hasn't been rented out yet. People better buy that at half price before it fills up. So we look at commodities roughly the same way. So some people will say, well, let's assume that the price of gold is going to drop to 1,400, 1,300, which most people are assuming still. And then let's put a discount rate on that of 5%, even 10%. That means the value of gold and silver and uranium that's mined, 5 years from now, 10 years from now, 15 years from now is essentially worthless under that model. You're assuming the price is going to drop, and then you're assuming a massive time value of money on that. Where we will look at that analysis, but we'll say, well, if we get a gold coin out and we say, what is that gold coin worth? We can all agree it's worth 1,700 something. I said, if I dig a hole in the ground and toss that coin in and bury it, what's it worth now? The wrong question is, what's the cash flow this year? It's worth 1,700. And for some reason, investors want to do this idea of low cash flows into the future instead of saying it's worth 1,700. And then, as we've already talked, it's quite likely to actually go up in value. It's strong cases that it's going to go up in price. So it has optionality value. So we look for companies that have lots of gold underground. And we say, what is that gold worth at 1,700? What's it worth at 2,000? What's it worth at higher? And then let's subtract the cost of digging it up, which can be substantial. And we buy it at a huge discount. And then if it's going to be mined next year or the year after, instead of penalizing them heavily, we actually kind of like that because options are worth more when you have time value. So if the gold's going to go from 1,700 to 2,000, the likelihood that that happens tomorrow, or essentially zero. The chance that it happens in the next 6 months is higher. The chance that it happens in the next 6 years is very high. So actually, we like having long-lived reserves. We like having more time for the price of assets to go up to the value we think that they ultimately are worth.
Very interesting. Very interesting. Dave, we're just going to take a quick break here. Remember, anyone with any questions, feel free to give me a call about your portfolio, any investment questions at all. You can always feel free to give me a call at 518-255-8854, or you can email me at edgardner@cutterco.com. We'll be right back on Money Nation.
All opinions expressed by Ed Gardner and or his guests on the Money Nation show are solely Ed Gardner's and or his guests' opinions and do not reflect the opinions of Cutter & Company or any of their affiliates. You should not treat any opinion expressed by Ed Gardner and or guests as a specific inducement to make a particular investment or follow a particular strategy, but only in as an expression of their opinion. Ed Gardner's and his guests' opinions are based on information he considers reliable, but neither Cutter & Company nor affiliates and or subsidies warrant its completeness or accuracy, and it should not be relied upon as such. Always talk to your financial advisor before making such decisions.
Welcome back to Money Nation. Dave, another question for you. Where are you finding value in the market right now?
All right. Well, as far as specifically, let's take your uranium quickly. I made the case that uranium should go up 2 or 3 times in price. There are holding companies out there that just hold yellowcake, the form of uranium. We hold some of those in Canada and the UK. We believe there's a good case they will go up in price. For those that want a little more upside potential, the 2 biggest uranium stocks in the world, one is Canadian and one is in Kazakhstan. Those give you an opportunity to do a little better than the raise in the price because you get operating leverage. Then for people that are willing to go with that latent value I talked about, there's some Canadian companies in particular that hold a lot of uranium, but the mines won't be built for a couple of years. I mentioned the optionality. These things are trading way too cheap, and by the time they're mining it in 3-6 years, whatever, the price of uranium could be a lot higher. Same thing with gold. I believe everybody should have some gold coins. I believe having money, and that we believe that's true money. We've seen the central bankers promise to devalue fiat currencies. So having some money in physical gold is something everybody should consider. But beyond that, we believe that by buying gold stocks, if they buy the big, well-known gold stocks, we think they'll do well. I think they'll do better than owning gold because you have the ability to find more gold and you have that optionality, the operating leverage if things go up. And there again, if people are willing to buy the publicly traded companies that own big reserves of gold, they have a lot of gold in the ground, but they are not yet mining it. Those are well undervalued in the marketplace, we believe. So we're very interested in that sector of the market.
Dave, is there any difference in gold bars or gold coins for physical ownership by investors?
There's the big bars that people that want to put a lot of money to work can do that. The small bars, the 1 ounce bars versus the 1 ounce coins, probably no big difference. The coins cost a little more because they have the stamp, and maybe people will recognize that more and they look better, but no big difference there. Having smaller sizes are probably available if people ever need it to transact with.
Right. How do interest rates affect the metals, gold, silver, and other commodities?
Yeah, that's a very good question. I think people get confused a lot. They say, well, if interest rates go up, that is bad for gold. The problem is people tend to be talking about nominal interest rates, where what matters is real interest rates. If I can own gold, I get no interest. If I hold currency, bonds, bank accounts, I get an interest rate. But if I can get an interest rate of 2%, while the value of the dollar is falling 4%, that's not so attractive. I'd rather own gold. And so it is the real interest rates that matter. Nominal interest rates, because they tend to lag so much or be depressed, actually gold in the 1970s went up a lot while interest rates were going up a lot. And why? Because the inflation rate was going up faster than interest rates were. You had negative real interest rates. In the 1980s, interest rates, 80s and 90s, interest rates dropped consistently. They dropped a lot. And the price of gold went down also. Why? Because inflation was falling faster than the interest rates. So you actually had increasing real interest rates. And we've seen in recent years the same sort of thing. So if interest rates go up because the Federal Reserve gets together and says, like Paul Volcker, we are going to stomp out inflation, we're taking interest rates to 22%, that will be bad for gold. But I think every central banker in the world has made clear that they have no intention of letting interest rates go above the rate of inflation. So they're pretty intent upon keeping negative real interest rates. So as we've seen in the last few months, if interest rates start to drift up, but the inflation rate's drifting up even faster, that is not bad for gold. That is good for gold and good for silver and good for other things. And so unless the mindset of central bankers and governments around the world change drastically, I think people are worrying about the wrong thing when they worry about interest rates hurting gold.
Interesting. With the $6 billion you guys manage, could you tell us, the listeners from Money Nation, a little bit about the different funds you guys manage?
Sure. We have one model portfolio, so all clients are treated equally, but we have a mutual fund, and so we have people in the mutual fund. We have a similar thing in Europe with a UCITS fund. And then we have institutional clients that and some high net worth individuals that invest directly with separate accounts with us. So we have different vehicles for to meet people's needs.
Very, very interesting. Anything, gold and silver, is there one that you like better right now, gold or silver?
I think over the long run, you can make a case that silver will do better. It certainly is underperforming gold. Almost everything is. Other commodities have not done as well as gold in recent years. So if you look at that ratio, I believe a case can be made silver will do better over the long run. In the short run, it'll depend somewhat on the economy. I think if the economy is doing better, that's better for the metals other than gold, and when the economy is doing worse, gold's used less industrially. But silver, back in 1980 and again 10 years back, silver's been at $50. So it's trading less than half of where it's been a couple of times, and the economics certainly is not encouraging people to build a lot of silver mines, where gold is still very, very attractive, but it is not trading at half of its all-time highs. So like gold a lot, like silver better. Also, I find platinum pretty interesting. Platinum used to trade at a huge premium to gold. Now it trades at a huge discount to gold. Platinum used to trade at like 5 times the price of palladium. Now it trades at half the price, less than. So that's pretty interesting also.
Last question, Dave. What sets Kopernik apart from other companies like you?
All right. Well, there are a lot of, well, not that many anymore, but companies that say they're value. We, of course, are value, but we I think, take a different approach than some. We are more willing to to make the hard decisions, such as buy really, really good companies that happen to be located in Brazil or Russia or China or Indonesia. And so that we get great cash flow. Another, we're more willing than most to buy things at half price without knowing whether it's going to take 1 year or 5 years for things to double. We think the math is very, very good on doubling in 5 years. So we will do a lot more of buying really valuable things that aren't on other people's radar screens because they don't like the uncertainty of owning gold or the discomfort of owning Brazil, those sort of things. So I think that's really puts us in good stead now because the market's become so much of correlated, a lot of people buying the same stocks. And so since the market itself has become really, really expensive, we like being in our own world, buying things that are really, really inexpensive right now. So we're liking where it is now.
That makes a lot of sense, Dave. Makes a lot of sense. Thank you very much for being with us. I look forward to talking to you in the future, and we'll check in down the road and see how everything's going. But thank you very much for your information today. I really appreciate you being on Money Nation today.
And that sounds great. Appreciate being here. Thank you.
Fantastic. Remember, listeners, any questions at all about your portfolio, investments, questions about your portfolio, IRA transfers, you're retiring, give me a call anytime or email. That's 518-255-8854 or Ed Gardner at cutterco.com. Thank you very much, everyone, for listening to Money Nation. Have a great day.